Welcome back. I'm absolutely thrilled to have you here for today's explainer. We're going to synthesize a seriously incredible array of recent data today. We're looking at everything from the engineering inside nuclear submarines to the quarterly earnings of major pizza chains, all to figure out the complex, shifting global economy of May 2026. Now, if you've been following the news lately, you know the headlines can feel, well, kind of disconnected, maybe even chaotic. But when we actually look at the underlying data together, a fascinating and deeply interconnected story emerges. Let's get into it.
Okay, let's dive into this. Corporate leaders today are observing a highly unorthodox blend of policies. We're talking about everything from demands to cap credit card rates to assertive direct government equity grabs in private companies. It's an environment where some executives are literally rehearsing what they're going to say in Oval Office meetings just to fend off the government asking for a stake in their company. It is a completely new paradigm.
So here's our agenda for today. First, reshaping the energy landscape. Second, geopolitics, Iran and oil. Third, the rise of state capitalism. And finally, a tale of two markets.
Section 1. Reshaping the energy landscape, from naval subs to the grid.
Right now, there's an intense search for reliable, low-carbon energy solutions to power our increasingly tech-heavy economy, right? And because of that, a massive amount of focus has turned to miniaturized nuclear reactors, which brings up a seemingly obvious question raised recently by nuclear energy enthusiasts: if U.S. Naval might already rests on submarines and aircraft carriers powered by small reactors that run reliably for decades, why not just adapt that exact naval technology for the civilian grid? As Nick Turin, a reactor core design expert, points out in our source material, people ask this question all the time. But to understand why it isn't so simple, we actually have to look back at the origins of this technology.
It all traces back to Admiral Hyman G. Rickover, who was basically the driving force behind the Navy's nuclear program in the 1950s. While his favorite design for the first nuclear submarine in 1954 became the global standard, making it work for civilian electricity was shockingly expensive. You see, naval reactors use highly enriched, expensive uranium and, well, they're built to survive combat. To make civilian power affordable, the industry had to go massive to achieve economies of scale. Rickover himself famously summed up the challenge in a 1953 memo. He contrasted hypothetical academic reactors, the ones that exist only on paper, use off-the-shelf parts, and are always cheap, with practical reactors. Those are the ones actually being built, and they're almost always complicated, incredibly expensive, and way behind schedule. Today, the financing costs for those massive, delayed megaprojects have become pretty astronomical, which has led to a renewed push for small, mass-produced reactors. But smart companies aren't putting all their chips on one specific design. Take BWX Technologies, for example. They've made over 400 reactors for the Navy, and they're taking an incredibly strategic approach to this atomic renaissance. As their CEO, Rex Gavetin, put it, they are planning to sell nuclear fuel and components for various reactor designs. They're betting on the race, not on the horse. And honestly, that's a brilliant way to mitigate risk in a highly uncertain new industry.
Section 2. Geopolitics, Iran and oil. The 36-hour escalation. Now, while energy innovation is a long-term game, our economy is absolutely still vulnerable to short-term regional instability. Let's walk through the timeline of what recently unfolded over a very tense 36 hours. At hour 0, Iran launched a barrage of missiles and drones at commercial ships, the U.S. Navy, and the UAE. By hour 12, American helicopters responded by sinking Iranian fast boats. Then, by hour 24, the president initiated Project Freedom. That was a U.S. operation to guide commercial ships through the Strait of Hormuz with naval and air support. Yet, almost as quickly as it started, by hour 36, operations were completely paused as the administration cited great progress in negotiations. This short-lived military exercise really exposed the incredibly volatile reality of the region, and it immediately brought global ship traffic in the strait to a grinding halt.
So the crucial point is how this geopolitical volatility translates directly into the global economy. Because of this uncertainty and the very real threat to shipping lanes, Brent crude, which is the global benchmark for oil, has spiked back above $100 a barrel, and that's a massive number. Elevated oil prices drive up inflation, dampen economic growth, and increase the cost of absolutely everything, from jet fuel to manufacturing. It essentially acts as a massive tax on the entire global economy.
Section 3. Rise of State Capitalism, the Government Portfolio.
Faced with these kinds of geopolitical threats and a deep desire to secure critical domestic supply chains, we're seeing a highly unorthodox shift toward assertive government intervention. The administration is taking direct equity stakes in private markets. To really grasp the scale of this, we just have to look at this single number right here, $11.1 billion. That is the size of the massive government equity stake taken in Intel during this administration. It represents a 10% share of the company, purchased at just over $20 a share. This is a prime example of this new era of state capitalism, where the federal government isn't just regulating critical industries anymore, it is actively investing billions of dollars to own a piece of them.
Now, what's really interesting about this slide is the actual performance data. The government's strategic stock picks are massively outperforming the broader market benchmarks. According to analysis by Barron's, since the announcement of these stakes, the S&P 500 has gained roughly 14%. Meanwhile, the government's investment in the critical minerals company MP Materials is up about 136%, netting roughly $1 billion in profit. And that Intel stake? The stock is up a staggering 370%. The U.S. government's shares in Intel are now valued at around $49 billion. To put that into perspective, that's $40 billion more than they originally paid for them.
However, this aggressive state intervention does face strict legal limits. The administration's trade policy, which has heavily relied on imposing tariffs, recently hit a major roadblock. The Court of International Trade actually struck down the president's new 10% global tariffs. The court ruled in a split decision that the administration did not properly apply the Trade Act of 1974. Essentially, they failed to identify the required conditions, like serious U.S. balance of payments deficits, to justify the temporary levies. This follows the Supreme Court striking down a previous slate of tariffs, clearly showing the friction between state capitalism and the judicial system.
Section 4. A tale of two markets. AI euphoria versus consumer reality.
And this brilliantly illustrates what happens when you combine high energy costs with geopolitical uncertainty and explosive tech innovation. Wall Street violently splits into the haves and the have-nots. You can see this extreme divergence in recent first-quarter stock performance. On one hand, you have Datadog, a cloud and cybersecurity provider, surging 31% as investors pour money into software and AI infrastructure. But on the completely opposite end of the spectrum, you have consumer mainstays just getting hammered. Whirlpool dropped 12% and suspended its 70-year-old dividend, citing plunging consumer confidence and recession fears driven by the Iran war. Shake Shack plummeted 28% due to growing beef costs and uneven customer traffic. Even Papa John's is seeing customers trade down to smaller pizzas and skip desserts. It is a stark contrast between tech euphoria and a very harsh consumer reality.
This intense concentration of wealth in the tech sector has a lot of market analysts looking to history, specifically comparing today's AI-driven surge to the peak of the dot-com bubble. And wow, the statistics are truly staggering. Through the third week of March in the year 2000, the top 10 performing stocks in the Nasdaq were up an average of 622%. Through this recent period in 2026, the top 10 are up 784%. The broader market is relying incredibly heavily on chip stock outperformance, and AI-related stocks now make up such a massive share of the S&P 500 that they are almost single-handedly driving the index's high valuation multiples.
So, what does this all mean? Well, it leaves us with this final, incredibly important question to consider. With AI innovation fundamentally distorting traditional economic metrics, state capitalism rewriting the rules of government intervention, and highly volatile geopolitical conflicts threatening global oil supplies, are we simply climbing a traditional wall of worry on our way to new economic heights? Or are we looking at the echoing technical indicators of the 2000 tech wreck, just waiting for the bubble to burst? It is an absolutely unprecedented landscape, and how these macro forces interact in the coming months will absolutely define the global economy for years to come. Thank you so much for joining me to explore this data today, and I'll see you in the next explainer.